All right, but let's wait for another 2 minutes or so because we still see people signing on just to make sure that everybody gets a chance to show up as they choose. All right, good. It's 11:01 Eastern time. Let's start this session of the Microstructure Exchange. We're very excited to have Pierre Collin-Dufresne here to present to us his paper on the ECB asset purchase program. So as I understand it, Pierre has not yet been given permission to circulate the paper, but he's been given special permission to give this talk to us. And so I think, he's also quite keen to get our feedback. Pierre has agreed that you can ask questions at any time. If you don't ask questions in the interim, I'm just going to stop him here and there and, ask him questions that may arise in the chat, which I want to encourage you to use too. And with all of that, I'm going to just hand over the floor to Pierre. Go ahead.
Great. Thanks a lot for the invitation. Yes, indeed. So we have this disclaimer, usual disclaimer. This is joint work with Johannes, Breckenfelder, and Stefano, Corradin at the ECB. I was hoping I would be able to also send you the paper, but we didn't quite make it yet through the compliance process, and we're getting quite some pushback on some of our findings from the ECB. So indeed, it's nice that they let me present it, and I'm kind of curious to get your insights. It's a fairly simple paper where, as you know, we've gone through a period of quantitative easing where, monetary policy was all about large-scale asset purchases. That period may actually be ending soon. But nevertheless, right, this new approach to monetary policy has raised many interesting questions about monetary policy, but we also think is a nice opportunity for us to study the microstructure of bond markets, because we have these very large investors purchasing large sums of assets in what we might have thought were very liquid and deep markets. And so it's a unique opportunity empirically, and then also think about the theory as to how these large purchases affect market prices. And so we're focusing on this European Central Bank PSPP, Public Sector Purchase Program, which is part of the, in fact, the largest part of the asset purchase program of the ECB. And we're going to focus mostly on the German Bund purchases. And we want to ask questions about, whether the central banks get efficient execution in their purchases. And of course, that sort of ties into thinking about how one might think about designing for the future, maybe these large scale asset purchases. And then if we step back, we think it's interesting to help us think about the structure of these sovereign bond markets and what is the role of bond dealers. And without waiting for the end of the paper, in a nutshell, our findings is that we think that these large-scale asset purchases, even in a market that we thought was very deep and liquid, like the Bund market, we think have created quite some distortions in prices, and we see some price patterns which we think have to do with this the presence of this asset purchase program. And so in a nutshell, the empirical evidence we have looks like this. This is the cumulative return, cumulative bond return around month end during this period of the purchase program. And you can see this run up about 10 days before end of month on average, and then a pretty quick fall off in a couple of days after month end. And so the question is, how might that arise, or might that be in part due to these asset purchase program? And so our interpretation And I'm going to show you a little bit of a small model and then a bunch of tests to try to convince you that this is what's going on, is that essentially the design of the program commits or announces that the ECB will, that the European Euro system will buy a very large amount of bonds, 60 billion for a large part of the program per month, and is committed to buy this large chunk by the month end. And that essentially in a market which may not be perfectly competitive with dealers providing quotes, the market power of dealers essentially increases as we approach month end, which may lead to something like this pattern. So this is a very quick summary of where I hope to get you. Now, of course, we know we're not the first ones to show evidence of some patterns in even government securities around scheduled periods of time or known in advance determinist period of time. There's this very nice paper by Lu, Zhan, and Yang, which I'm sure you're aware of, where essentially these authors demonstrate that around repeated, scheduled, and deterministic treasury auctions, the yields there, the picture I showed you for our data was returns on bonds. So of course they go in the opposite direction of theirs. They're looking at yields. So they show that yields go up into the auctions and then drop thereafter, which means of course that their prices are going down into the auction and recovering thereafter. So it's kind of the mirror image, if you so want, of our picture, where in our case the ECB or the central system is buying bonds, and the bonds are going up into the month end, and here the government essentially selling bond, and prices are dropping. However, we think that the mechanism might be quite different. So I want to sort of contrast this picture from their paper and sort of highlight a few features that are different. First of all, notice that in their case, the pattern is quite symmetric, whereas in our case, the run-up is smooth into the month end and then drops sharply thereafter. Here, the pattern is also identical for the bonds that are being auctioned, the on-the-run bonds, as well as also for the off-the-run bonds. And you cannot, if you compare the pictures, statistically, they don't look actually very different. So the auction cycle seems to affect both the bonds that are being sold and the bonds that are close substitutes. And I'm going to show you in our case that the pattern is much stronger for those bonds that are actually being purchased by the bank as opposed to those that are not being purchased. So those are a few things that I wanted to highlight. Now, the interpretation that's proposed in this Lu, Yan, and Zhang paper is one of limited risk bearing or warehousing risks. Right? The argument they make, the story they tell to interpret this data is that we have a limited set of dealers. These dealers have to take on risk on their balance sheet when the government wants to issue bonds, and therefore they need to be compensated for this inventory risk or this warehousing risk for a period of time. And of course, as a result, these dealers also short other notes that are close substitutes, which explains the spillover effect to the other bonds. It's about essentially the risk-bearing capacity of the marginal investors in those notes around those auction periods. And then, of course, we need some story for why other market participants are not stepping in and helping, collect that excess risk premium, if you want. Why do the government need to lose money on their auctions repeatedly? Why are not other market participants stepping in? In our case, it's kind of different because it's hard to, I think, tell the same story in the sense that here, essentially, the ECB is taking duration risk off the balance sheet. So it's harder to make the point that by acquiring risky assets from dealers, we would somehow need to compensate them for giving them cash and taking risk off their balance sheet. So it's, I think, a more difficult story to tell, this warehousing risk story. Although there might be some links that I'll try to discuss later about, how do these dealers actually find the bonds that they sell to the ECB? They might need to find them and finance themselves. So there might be some link to financing costs to locate those bonds that they're going to sell to the central bank. And that may be one mechanism. However, if we think that on average, there's lots and lots of banks with bonds, German bonds on their balance sheet, then this risk story seems to be less applicable to our finding. Another interesting comment about this effect that Zhang and Yang find is that the evidence in the euro area is more mixed about these effects around auctions. The effect, this price concession, we don't see as much of an effect in the euro area, especially not around German Bund auctions. There's this nice paper that documents that there's some effects around Italian auctions, but not around the German sovereign bond auctions, which is what we're focusing on. And the effect that's found around Italian auctions, there are some nice papers that say that they might actually be compensation for asymmetric information about the amount about some uncertainty about the amount that's going to be issued. And in our case, there's no uncertainty about the amount that's being purchased. That's being announced very clearly. And I'll show you some data that shows that the amount that was going to be purchased was very well documented and announced by the central bank. Now we have lots of, we have theories about price impact and related to asymmetric information, related to to imperfect risk sharing, such as the Duffy slow-moving capital or inelastic markets. But we think these stories don't apply, and we can discuss that maybe later as well to our setting, where essentially the effect we document is not very long-lived. It sort of happens around month end, starts about 10, 11 days before month's end, and then reverts quickly thereafter. So it's probably harder to explain with some of these other mechanisms. So we really want to focus in our explanation on this notion of imperfectly competitive dealer markets. I'm gonna sort of skip the Reddit literature, since I think I have only 45 minutes, right, for my presentation. But I want to point out that there's also two very nice papers that we found, and probably others, but those are the ones we're aware of, that document that this QE asset purchase, look at QE asset purchase program also from a microstructure perspective, and that also find that in the US there are also some evidence of market power exerted by dealers to extract some rents from these transactions. I want to point out that our theory is building a lot on these sequential search models. So essentially, we're building on this paper by Duffy, Dvorak, and Zhu that itself is building on these papers from the consumer literature, and we're going to essentially use that framework, but try to build some dynamics there to be able to model this repeated interaction over many rounds of a large buyer repeatedly going to the same dealers to buy a fixed number of units, and then try to see how this works out, how this setting potentially can generate the price patterns that we see. Okay, so what I want to take you through is some evidence on this, empirical evidence on this, how this PSPP and this purchase program works. Some empirical facts, then I'll present you the theory, and then some empirical analysis. I know Andreas was eager that I leave you some time to ask questions, so let me know if you have any questions, about what we're doing or any remarks, then please tell me. And in fact, otherwise, if you have any questions, feel free to interrupt me anytime.
Yeah, so maybe this is the time when I'm going to interrupt. Is there, so just to make sure if there's any audience questions at this time already. I already have questions lingering, but I first want to see how you set up your theory before I start asking. But is there anybody else who wants to ask anything at this point? Yep, there's a hand up. Pete, of course.
Yeah, just on the basic theory here, there are a couple of points. One is that if the seller, if you have a symmetric model of adverse selection or market power, either one, but especially market power, there are not going to be any price effects of it, because the buy side of the market has the same amount of monopoly power as the sell side. I meant to say just market power. On the other hand, if one of the one side of the market is much more impatient, or there's some asymmetry, then you would expect price effects. And that seems to me to be the relevant theory. There's a nice dissertation by Pralab Day in Australia that deals with this. Zhang Min Li and I have a paper which deal with this issue as well.
So I'm not aware of these papers, but I would love to get your reference. I'm worried that you'd be very disappointed about our theory. The model is really simple, you'll see, but the basic idea basic idea is going to be that we're going to assume that the buyer is committed to buy some fixed number of units from finite number of sellers, and essentially they're saying we have some reservation value for that asset. We want to buy, 2 units. We have got 2 periods to buy them, and if you actually postpone how much you buy to the last period, and dealers, that with probably one you will want to buy, and they know your reservation value, then they're going to ask for the maximum price. So it's basically some very simple mechanism like this, and I want to hopefully
if the Fed or the ECB wants to get a better price, they just need to behave with as much impatience as a bank dealer does.
No, indeed. So part of the point of this paper is that we think that the way they designed the program was, and I think this is why they're not happy with what we're saying, but that essentially they tied their hands a little bit too much in saying exactly how much they were going to buy and committing to it.
And the state of California did that in the electricity crisis as well. And you can argue that it is in the case of the central banks, they've always been very protectionist towards the banks they regulate. This is just a way of increasing the profitability of the banks, which have the privately owned banks, which have captured the central bank. Why the central banks insist on behaving this way, I don't know. It goes back, the first paper I remember reading on this particular topic was L.A. Kamak's dissertation back in 1982-ish. So it's a topic that's been around for a long time, and central banks have been aware of this issue, and it's been how many years since 1982? 40? And they haven't done anything. So, as you're pointing out.
Well, okay, that's a good discussion to have. Why are they not changing? Why are they not implementing it in a slightly different way? I think here at least they seem to respond to some of this result by, for example, for the pandemic emergency purchase program that they've implemented afterwards, they've changed some of those things. So I think they're not necessarily always aware of. I think maybe to their defense, maybe they might have thought that by going to 2 or 3 dealers, that you would be close to getting price competition from 3 people, and that maybe maybe that would be sufficient to get close to the competitive outcome. And maybe they thought that the bond market's fairly deep, and price transparency is pretty high, so maybe that would be sufficient.
That's contradicted by their longstanding practices in the U.S. market, where they had pay-as-bid auctions, which obviously result in a worse outcome to the seller. So they were designing the auction themselves intentionally to maximize their trading costs for many decades, and then that got changed. That didn't take 40 years to get changed, because it got changed 20 years ago or something.
So I may be in your case just showing a result that only keep on convincing you of something you already know, and then the puzzling thing is why are there you would think they're implementing programs in the interest of taxpayers and not in the interest of providing rents to dealers. I guess dealers are also taxpayers in some level, but so maybe our results are just confirming something you already know. It's maybe another piece of evidence in the same direction of what you know. Andreas, you said you might have a question.
No. I will have. Probably have questions after the model. So go ahead. So I'm fine.
Okay, great. All right. So let me then run you through the data we have. So the particular program we're focusing on is this APP program announced by the ECB in 2015. We're focusing on the APP was a large program that said they would buy around $60 billion euros worth of bonds per month. The largest fraction of this APP was the PSPP, the Public Sector Purchase Program, which is almost 82% of the total purchases. And of that program, the largest share is the German sovereign bond purchases, because essentially the ECB is committed to buying the public sector bonds according to the so-called capital keys. So how much every European country owns is shareholder in the ECB. And Germany has the highest shareholder, so 26%. That means that, of these 60 billion, 82% were purchased by, in the form of sovereign bonds, and 26% of those were German. So this meant buying approximately 13 billion euros. And then the program was ramped up to 80 billion. So then this 13 billion was increased to close to 18 billion per month of German sovereign bonds, which effectively was quite a large amount of purchase of German sovereign bonds. In the end, the Euro system owned about 24% by 2017 of all the German outstanding bonds. You can see here the target for the AVP. You can see that it's fairly well known and it's fairly stable. And what's interesting for our analysis, which we'll use, is you see that these green bars, which is the essentially monthly targeted purchases of these public sector bonds, you can see that they decrease at various periods during the sample, and that's because, and this was also announced in advance, essentially the Euro system was trying to avoid buying when they had evidence that markets were less liquid. So they were trying to essentially buy a constant amount, but as they say, front loading, buying slightly more during the more liquid periods of time and buying slightly less during the less liquid period of times, where liquidity was essentially measured using market liquidity, things like Kyle type price impact measures or bid-ask spreads. So they're trying to buy more when market liquidity is higher. And that's an interesting thing we're going to use for our empirical experiment. Essentially, I'm going to show you that the pattern that we observe, the price impact pattern we observe, is actually larger when they buy more, even though markets are supposed to be more liquid. And in fact, standard market liquidity measures suggest that markets are more liquid during these periods, which suggests that the pattern we see, even though it looks like a price impact pattern, is not driven by the same mechanism as the classic bid-ask spread type of trading liquidity that we typically mention. Now, the way these purchases are executed, they're executed both by the national central bank, so in this case by the German Bundesbank, as well as by the ECB's system. And they're executed mainly via bilateral trades going to dealers. They use many different routes to trade. Typically, they ask for at least 3 quotes. They want at least obtain 3 quotes, and the lowest price wins. Now, to give you a sense of how they purchase through the month, you can see that if they were just doing a 1/n type rule, they would purchase about 5%, 20 trading days, so they would purchase about 5% per day. The median is the middle of these boxes. The median is close to 5%, but you can see that as we approach month end, there's a little bit more variation in the actual purchase. But still, you can see that they're essentially targeting the median purchase, so 1/n rule. Okay, so we focus on German data. We have the data from Bloomberg and Trax, which is a trading platform. We have, what's interesting, the actual transactions by the ECB and the National Central Bank, the amount purchased, the executed price. We know there are identities of the parties, and we can also have some data on the quotes that they obtain. We know, of course, bond characteristics, and we have repo data. I'm not going to spend too much time in the interest of time on summary statistics, but I just want to say that most of the purchases they're doing are in fixed rate bonds issued by the central government as opposed to the states, and point out that the number of counterparties, the average number of counterparty that they trade within 1 day is typically 1. So it's 1.29. So on most of their trades, they actually trade only with 1 counterparty within a day. So the way we document the pattern is we do something really simple. We're essentially looking at the change in yield relative to T-9, and then we're essentially looking at the average change in yield. So we have a dummy for the day, and then we look at the coefficient on that dummy, which is essentially a measure of the average cumulative change in the yield from T-9 to T+10. And then, this is now the pattern in terms of the yield change. So, before I showed you the bond return here, this is the yield change. Of course, what you see is that on average yields drop about, 9 days before month end, yields drop. You get about 4.4 basis point drop. And then you recover within 2 days. And, to put this into perspective, remember, this is a period of time when the average yield was very close to zero. So the average level was about 0.1%, and we have a 4.4 basis point drop, which is twice as large as the evidence documented in around U.S. Treasury auctions, where the average yield was around 4 or 5%. So we have a in terms of the magnitude of this effect, it's much larger than the effect documented around U.S. Treasury auctions. Okay. Now, how robust is this? We work, we add bond and window fixed effects, and we do lots and lots of robustness checks. I'm not going to take you through all of them. This data here was essentially the effect on prices we get from Bloomberg. We check whether this effect, holds if we use different data sources. So we look at the actual executed quotes from the central bank, the actual trades that they do, and we see that the picture is actually more dramatic. So it has the same shape. It's very statistically significant, but it's also in fact larger. So the effect on the bonds targeted by ECB is actually larger than the average effect I showed you on the previous slide. So it's not due to a data issue. Then here, an interesting thing is we show that the effect, if we focus on around quarter ends, is actually more dramatic. So this is the effect with all the data, and this is the effect without quarter ends. So we see that the pattern is statistically significant both on quarter ends and outside quarter ends, but it's more dramatic around quarter ends, which amplifies the framework. And so when I discuss the model, I'm going to argue that one interpretation of this is that around quarter ends, there's less competition, even less competition among dealers to provide liquidity, because some of them may be constrained in their balance sheet. They may not want to take on, more, say repo to locate the bonds and sell them to the ECB. So we may be facing even less competition among dealers around quarter ends. We look at, might think, well, maybe there's a general pattern during that period for some random reason. We don't know why. So what we do is we look at the difference between bonds that were issued by German states, but they were not eligible during half of the window for purchases by the ECB. And we look at the difference between the bonds that are eligible issued by the central German government versus the bonds that are issued by states and that were not eligible. And we find that, the pattern is there in the difference, which tells us that it's not a general, pattern applying to all bonds issued by German entities. We took out newly issued bonds. There might have been some effect, like the issuance effect that I documented before. And if you think the issuance effect, if issuances happen mid-month, and then you might think, well, if around issuances bonds are dropping, then yields would go up and they might recover around month's end. So it might be due to issuances. So we drop issuances and nothing changes. We look at whether there's a pattern in bid-ask spread around month end. We don't find any sort of remarkable patterns. And then lastly, we do a placebo effect where we look at the same picture a year before to see if, there's always this pattern, even when there was no APP. And there we don't find anything notable outside of the APP window. So, with that, hopefully we document that this pattern is fairly robust during that period. Let me present you the little toy model we have to try to explain what might generate this finding, and then suggest further implications that we might look for to try to give further support to this interpretation of the data.
And can I interrupt you for 1 second? I just have a quick question. Please. So you said that the median number of counterparties that they pick on each given day is just 1 or 1.3.
Yeah.
Is that by choice, or is that by availability? And is there some form of anything? I mean, I'm not sure if you can identify the counterparty, but that sounds really quite fishy, right? Is that maybe that the dealers themselves are doing some round robin availability?
I think what happens is they probably I think they ask for quotes from many dealers, maybe 3 to 5, and then they will get back quotes from at least 3. They need to get back quotes from at least 3 to be able to do a trade. And so I think any given day they're going to select some counterparties, send them requests for quotes, get back at least 3 quotes, then select the smallest one. And I think they probably do only about 1 or 2 trades per day. And so then they will typically do that one trade with that one, so sometimes a bit more trades with that one counterparty that sends them back a quote. And so I think the issue might be that you might think, well, if everybody was always sending you back 3 quotes, if you put 3 people in competition and they're competing in price, then getting back 3 competitive quotes from three guys who have all access to this very deep markets to source their purchase of bonds might be sufficient to get you close to Bertrand competition. But I think our thinking is that probably what may happen is, and this is very reduced from the model we have here, is that even though you get at least 3 quotes, right, some of these quotes may be just not really there, right? So there's if a dealer actually doesn't have the bond in inventory, or if a dealer doesn't actually want to be there, it's probably not going to not send a quote to the ECB. He's probably going to send something that he knows is a bit off market, and then the ECB will just trade with the smallest, with the most attractive quotes of those 3. So just the fact that you're getting 3 quotes, if they're not at market really, is I think not sufficient to ensure that you get close to a competitive outcome. So this is is that right?
Well, it's not surprising, actually. I mean, I wouldn't say not surprising, but there's so much ample evidence in other markets, like in spectrum auctions too, where the different parties, you would imagine that they would compete for price, but then they don't, because they almost have a system by which they figure out a mechanism by which they just one party bids low on one in each given day, and so the others are just bidding sufficiently high so that they wouldn't be taken, and yet collectively they can extract rents from the counterparty.
So that's one thing that's missing, that we're still thinking. I mean, this is preliminary work, but one thing we're still thinking. I'm going to present you the model, then I'm going to tell you in which direction we'd like to extend it. The thing that we'd like to endogenize is this ADA here. So let me just tell you the very simple framework, and then tell you how what would be nice, I think, to think about. So here we say, suppose a very simple model. You've got a central bank who wants to purchase U units from N dealers. The central bank has a reservation value of V at T. So V, think of it as known excess value the central bank we know is willing to pay for each unit, so it can fill its quota, right? So we assume that dealers, they can acquire the asset at the value of 0. But, it could be any cost C that's less than V would be the same. So let's just say that V is the excess known reservation value that the central bank is willing to pay in the last round to purchase an extra unit, right? And then, we assume that every dealer is contacted, so that the central bank actually contacts every dealer in every round, but the dealers will respond only with some fixed probability ADA, less than 1, and that's crucial. If everybody knows that every dealer responds every time, then they're always in competition with each other and they compete in price. But the fact that everybody knows that with some probability, not everyone will quote, that's going to affect their quoting behavior. So that's the crucial aspect. What would be nice would be to endogenize this ADA, because you can imagine that that it's in their incentives to think of a system. If nobody would choose ADA equals 1, because then they know they're competing in price, they get no rents, and nobody would choose ADA equals 0, because of course then they never quote. So it'd be nice to think of a mechanism by which they kind of agree to have some finite quoting technology, if you want. And then we have these tier rounds of trading. The central bank's objective will be to minimize the total cost that they pay to acquire the U units over these T rounds from the dealers. And the dealer will try to will choose its quoting strategy to maximize the expected profit from selling bonds to the central bank over these T rounds, assuming dealers can always buy the units at 0. There's they can always supply themselves with units. We assume that dealers are identical. And of course, the mechanism now that dealers know when they quote in earlier rounds that they're competing with other dealers that might be quoting in the same round, and they also know that they're quoting with dealers that might be quoting in subsequent rounds. And so you can see the mechanisms that as you approach T, it is less and less competition with other dealers, provided eta is not high. And so what we do is we derive the equilibrium distribution of quotes in every round, such that dealers essentially quote from an IID distribution with continuous support, and they're indifferent between any of the quotes that they post. And we calculate the equilibrium average transaction price at which the central bank will typically buy the targeted bonds. And what we find is that in that model, essentially when eta is not too high, then we'll see that rents will go, the bargaining power will increase for dealers as you approach T, and you can generate interesting average transaction patterns that are consistent with what we see in the data. So to show you the mechanism of the model, I'm going to focus first on the simple case where the central bank wants to buy only one unit over T rounds, okay, and then I'll show you how it expands to buying multiple units over T rounds. So here's a very simple model. You start in the last round, you move backwards. In the last round, consider a dealer who quotes the highest reservation value that the central bank is willing to pay. We know that's V. Well, of course, that dealer will get a profit, an expected profit if he quotes V of V minus his cost 0. So you get the profit of V if he's the only guy quoting, right? And the probability as the only guy quoting is 1 minus eta to the other. So that's the expected profit if a dealer quotes V. Now consider a dealer quoting P, any price P less than V. That dealer will essentially earn P minus his cost of 0. So it's profit of P if he happens to be the among all the dealers quoting, he happens to have the lowest quote. So of course there's a probability that there's K dealers quoting that's equal to this quantity here, and then if there are K dealers quoting, he will only get executed if all these other K dealers quote a higher price, which is 1 minus this density. And so for a dealer to be in difference between quoting P or V, we set this equation 1 to equation 2, and that gives us the endogenous density, continuous density, from which a dealer would be indifferent between quoting P or the maximum reservation value of the central bank at maturity. And so we get this nice indifference condition, and this approach here is what has been done in these previous papers. This is the same mechanism that had been used in some of these papers I mentioned in the introductory slides. So we get this nice explicit solution for this endogenous quoting density in the terminal round as a function of the maximum reservation value the ECB is willing to pay in the terminal round, and we can get an explicit solution for this density that solves these two indifference conditions. But the new thing here is that now we will step back one period and we'll say, okay, if that's the endogenous density in the last round, what about a round before? And so in the previous round, we have the same indifference condition, exactly the same, but what changes is what is the maximum reservation value that the central bank is going to be willing to pay. In the last round, that's V, the maximum reservation value we know the bank will want to pay. But in the previous round, this is actually going to be a decision variable for the central bank. This is going to be the maximum value the central bank will be willing to pay for a bond is the price at which the surplus the central bank collects from buying at that maximum price makes the central bank indifferent with waiting and buying in future rounds. And so we can find this upper bound here as a solution to this dynamic problem from the central bank. And so that's what we do here. We say, what's the maximum price that the central bank is willing to pay to acquire that unit in round T? Well, it's, if it buys at this price in round T, its surplus will be V minus PT, because that's the maximum reservation value we're willing to pay. And it has to be indifferent between essentially paying that price and earning that surplus or waiting and having, there's some time preference parameter beta. It could be 1, but it could be some number less than 1 for without loss of, just for generality. And then, then it's indifferent if it's pays now and earns the surplus for sure, or waits and in the subsequent round gets the maximum surplus. So in the subsequent round, there might be N dealers quoting with some probability, some price generated from this optimal density in the future round. And then if nobody quotes in the future round, then it has to move to the next round. So we have this dynamic equation that pins down the maximum price that the central bank would be willing to pay in any given round T, given the future known distribution with which dealers will quote in future rounds, and given the reservation price the central bank has in future rounds. And so we get this nice recursive structure where we can construct the equilibrium quoting density of dealers and the range of that essentially determines the trading policy of the central bank. And so, we need to be able to solve, we need to solve for this quantity here, which is the maximum surplus of n dealers quoting with some probability drawn from some IID distribution. That's just, some algebra. Turns out you can do everything explicitly in this framework. So you can calculate the expected surplus, and that has this nice form. You can calculate the maximum, etc. So this is just algebra. I will not, in the interest of time, will not waste your time with that. But you can get everything in closed form, and so in the end, you get everything explicitly, which is the dynamic equation for the maximum reservation price the central bank is willing to pay in any given round as a function of the future reservation prices, and you can get the endogenous quoting density. And so with that, you can throw in some parameter values and then look at the implied implication of the model. And so what you get is something like this. Here I choose a simple parameterization where you have 10 dealers. You want to buy over 20 periods, 1 unit. The reservation value of the central bank is 1. The cost to dealers of acquiring is 0, and there's only on average in any given period only 1 dealer quoting. So eta is equal to 0.1, meaning that of course it's an exponential distribution, so it's a binomial distribution, so there might be more than 1, but on average we expect 1 dealer to quote in any given round. And so what you see is that if there's only 1 guy quoting in any given round, then what you see is that the quoting range essentially starts very close to 0, because indeed at time 0, even though on average only 1 guy comes, he knows that the dealer knows he's competing with himself and future dealers in future rounds, and therefore he quotes close to the competitive Bertrand price of 0. But as we approach maturity, the quoting range starts to grow as the dealer knows that there's less competition over a future round, and the ECB is worried that it may never be able to trade. And so we get this increase in the trading range. And so correspondingly, we see that the average expected trading surplus for the central bank starts from close to 1, so maximum surplus to the central bank as it's essentially paying close to 0 for a unit, to essentially having to pay close to its reservation value at maturity, and so its expected surplus is dropping. And so you can see that if the market's it's not very competitive in the sense that there's only very few dealers that are expected to trade aggressively in any given round, then we can get this price pattern consistent with what we see. Now, of course, this is a simple model where the central bank only wants to trade 1 unit. So in this model, the first time that the dealer quotes, there will be a transaction and it will be done, right? But the same kind of pattern will arise if we actually get the central bank to buy more units from these dealers over several rounds. I'm going to show you. And of course, if we increase eta, so if we say that now, for example, here there's eta is 0.5, so there's 5 dealers expected to come in any round, then of course we get to an outcome that's much more close to this competitive outcome we would expect, where essentially the price is very stable and the range of prices we observe being quoted is very narrow, around close to 0. So we see a much more stable pattern. And so this very simple model, by moving eta from 0.1 to 0.5, gets you from a sort of flat constant pattern to generating this increasing price pattern that we documented in the data. Now, what happens if we want to think of the well, maybe I can stop here. Any questions on the model? It's very simple, this model, but
sorry. I see there's a number of questions in the chat. Let's start with Pete, maybe quickly with Peter. Why is this theory applicable only to QE purchases? Where does QE enter the picture?
No, it's a good point. I mean, it's not so far it's not applicable only to QE. It's just that QE is so far the theory only is applicable to any environment where you have a large buyer buying from set of dealers. The only reason we used it here is that we think the QE is a particular example where essentially they set themselves up with a framework where they commit to buying a certain number of units over a finite number of rounds. But if you have other examples in mind where you have a similar situation, you would expect similar type of patterns to apply.
Yeah. So Marius has a question. Marius, do you want to ask it live?
Sure. Hi, Pierre. If my understanding is correct, once you contact a dealer at time t and they give you a quote, then next period they have the exact same probability to sort of give you a quote as anybody else, right? So it's independent across time. Whereas I would think that you can collect quotes over time and sort of compare them at the end, which would go against sort of like giving the bargaining power to the dealers. What would happen if quotes were valid like 2 or 3 periods, for example?
Yeah, no, it's a good point. So we assume eta is constant, and you may not want to make eta constant. And the theory is not hard to. The theory is very easy to extend to allow eta to, for example, be a function of the trading round. That's very easy. So if you think a trading, what is a trading round? I mean, we don't have that specified here. I think you think of it that every time you go back to dealers to trade is a trading round, and every time you contact the end dealers for quotes, that we would call that a trading round. Maybe it's once a day for the ECB, maybe it's twice a day. And it's very easy to make eta the function of the trading round. It's also fairly easy, although it's just algebraically complicated, but it's not complicated to make eta also a function of the dealer. So you might think, well, I know something about my dealers. I know that Goldman will quote much more often than, I don't know, Bank of New York. And so you may have an eta that's a function of a dealer. As long as there's common knowledge, that's not hard to extend the theory. Then I think the nice thing, I think was also alluded to by Andreas, would be to try to say, well, how might such an eta arise from behavior? Like, maybe like if Andreas was mentioning, other markets where maybe you think that people have some implicit colluding behavior. I mean, it's not illegal collusion, but maybe there's outcome of some mechanism. Because here it seems clearly, if you believe that structure, it clearly seems not optimal to choose eta equal to 1 or eta equal to 0. And so if you could find a way to sort of find a market mechanism that makes you agree on some specific eta, maybe that would be interesting. So we haven't done that, thinking about ways to endogenize this eta.
Pete, do you want to quickly?
Yeah, just quickly, it seems like if you add more time periods, more auctions, you lower your average price. And so doing lots of them frequently together might make sense, which is what I think people in, big traders and markets actually do. But I'll leave it at.
Yeah, exactly. So if you think about, if you believe this mechanism is actually partly responsible for the price impact and these that we document, then one way is to have an infinite horizon. One way is not to commit to a fixed known number of purchases. So yeah, increasing the number of trading periods or increasing the number of people you go to, increasing the number, making the markets more competitive in any given way is going to be the right way to go.
So can I ask, and this may be a little bit too far outfield, but if we go with the idea that the dealers actually have to quote what they want to sell to the central bank, that could be difficult. Could there be a competitive problem at the other end of the spectrum where maybe the dealers don't actually have sufficient amount of the bunds in their inventory, need to buy it somewhere, and that this gives more market power to say some particular large pension funds or the like, and that may limit or have an effect on the prices?
Yeah, so I think that's right. So I think if you think what does ETA stand for? ETA might stand for the fact that some dealers have some inventory and others have not, and the ones who don't, they probably need to look for it, source it maybe in the repo market, and that might be one source of trying to think about what generates this data. So I think, yeah, the fact that, and so I think that's right, that the one aspect that might be partly responsible for this pattern is if there's balance sheet costs on the part of the dealers. If some dealers are more constrained in some periods of time, then this will also lower the amount of competition in among dealers. So this is actually in part how we interpret the fact that the pattern is much more important around quarter ends, where we can see that around quarter ends, since we know how many dealers are quoting, we want to actually explore that further. We haven't done that yet, but our hunch is that around quarter end, it's a much smaller number of dealers actually are active in quoting to the central bank. So it's probably a much smaller number of guys who are actually present, but we haven't actually shown that yet in the data. The only thing that I haven't shown to show you later is that what we do is we do split the data into periods of time when over a given month they trade with more dealers and month where they trade with less dealers. And we find very strong evidence that the pattern is much stronger in those windows when they access fewer dealers.
Okay, thank you.
I think there's a question by...
Yeah, the Jose Sebastian has a question also, has his hands up.
Hi, yes. So I wanted to know to what extent this model reflects the actual commitment power of the quote. So that's an important issue here in the mechanism. When you make a quote, how committed you are to that price, or when you make it general to the quantity as well. What is the actual mechanism in the ECB process?
So in the model, yeah, the idea in the model is that if you quote, eta is a stand-in for, if you quote with probably eta, then your quote is firm, and if they hit you, then you will have to deliver on that price. I'm not exactly sure how this works at the ECB. Whether my guess is that if you're one of the dealers and you quote a price, and they come to you, then I think you probably committed to that price. Now, I'm not saying that if you told them, well, actually, I can't do it anymore, you would be in the box forever. But so in that sense, but I would imagine that it's a pretty firm quote. At the same time, I think it's very easy for a dealer to make a quote where you know for sure that they're not going to hit you. So I think so this was what I was trying to say before, that the fact that they insist on having 3 quotes, which here in the model, it can be with some probability that you're the only one quoting. You might think, well, that's not consistent with the way they trade, since they insist on having 3 quotes. I don't think that's a big issue, in the sense that you might get 3 quotes, but only one of them might actually be really a good quote. The other ones may be so far from where they know the dealers know the market is, that they're not. It's like not quoting in our model. I don't know if that answers your question.
Well, kind of. The problem is that you would imagine that there is not just a one call to see what the quote is, but there is a communication process, and out of that communication process, at some point there is a full commitment, and during that process, there's a back and forth, and my guess is that that's going to alter a little bit the mechanism, and therefore may not be as clean as the theory that you're proposing does, and it would actually be more collusive to allow this weakened commitment in the process to get into a price, precisely because of this deadline at the end, whereby by prolonging your discussion and your commitment to a good quote will increase the impatience of the ECB.
It's a good question. I think I don't know I can't answer really exactly your point. My guess is they use several ways to trade, including some electronic approaches where they just ask for quotes electronically from dealers. In that case, I don't think there's much of a communication. They just get 3-5 quotes back, and they hit the lowest one. But it could be that I know they also use the phone for some trades, in which case what you're pointing out may be at work. I just don't know. I also don't know how to.
Also, at this issue, that the scale of the purchase relative to a standard purchase is actually important, which you haven't mentioned. So if you could make a quick comment of what the relative size of these orders are.
Yeah. So they, as I said, they purchase about 13 billion per month, which is a very large amount. You can see here that the let's see here. You can see that how big are their purchases? Typically they're close to 1% of the outstanding volume of bonds, and you can see that if you want to compare it, say, to the volume on the Trax platform, which is a very large electronic trading platform for trading sovereign bonds, you can see that they're about 10% of the daily volume on the Trax platform. So they're quite large, and given that the German Bund is not actually the largest amount of debt outstanding in the Eurozone, by the end of the program, they owned about 24% of the total outstanding supply of bonds. So it's quite significant in terms of the amount that they trade.
Wow. I want to ask, so Michael asked a question which asks whether or not the central bank only solicits offer for one particular type of issue, or do they basically cover the entire spectrum?
So you know, you're gonna take my answer with a grain of salt, because I'm gonna say what I think is going on, but I don't know 100% that what I'm saying is true. But what I think they do is they ask for specific ISINs. So they ask for quotes for specific ISINs. They have a way of selecting specific ISINs. They have some guidelines. They have some strict rules as to which bonds are actually eligible. So there's some bonds, for example, that are clearly ineligible based on time to maturity and based on the yield that these bonds charge you. Also based on issuance, they're not allowed to get close to recently issued bonds. So there are some restrictions on what they call the eligible collateral. And then within that eligible collateral, which these rules are fairly well known by, they're pretty much known by the market. Within the eligible collateral, they're going to typically have a trader inside the system will have a decision as to which ISIN to ask for a quote on, and then they'll ask for a quote on that particular ISIN, and then they will get quotes on these ISINs and then hit the lowest price. So it's not like they say, give me a quote on any kind of basket, and then people come back with random baskets. These are really more specific quotes.
Maybe you should move on so that you can conclude reasonably in time.
How much I still have about when I forget, when did I start? 5?
Yeah, we usually go a little bit after 12 anyway, or
okay.
After the hour, so it's not a big deal.
Okay, so I will get to that. So the multi-unit model works essentially the same as the one unit model, except that you have more algebra. So I'm gonna spare you the maybe the math, and then go directly. So what happens? You can see, for example, if you come into the last unit, into the last period, and you still need to buy, you only need to buy 1 unit, then of course you're in the same framework as before, where you needed to buy 1 unit. So the density, the indentionist quoting density is like this. If you come into the last round and the central bank still needs to buy 2 units, then the equilibrium quoting density shifts to the right, obviously, as the dealers know they have more market power, and so they can ask for they can quote higher prices. And so coming into the last round with more units to purchase is not a good situation to be in. And so it's in the interest of the central bank to try to spread its trading and buy early on to avoid getting into the last round and having many units remaining. And so if you saw for the quoting range, you get some really nice, some interesting patterns. So here, on the upper panel here, you see the equilibrium quoting range in the case where you have on average 1 dealer coming to the market. At the beginning of the trading rounds, the central bank needs to buy 5 units, okay? And so what you see is the difference between the left-hand and the right-hand side panel is that in the left-hand side panel, the central bank comes into the round and needs to buy 5 units, and there is actually never anybody quoting. And so then you see the evolution of the quoting range of the central bank needing to buy 5 units, and in equilibrium, never anybody actually showed up with a quote. And so, of course, as we get to the final period, the ECB is really eager in this model to want to buy those 5 units. And in the terminal round, we're going to get, obviously the surplus that it's going to extract from these is going to be very low, because all the market power will be the dealers. There's on average 1 guy coming, and the dealer knows that the central bank still has 5 units to buy. Here, what you see is that the initial range is the same as on the left-hand side, but in period 5, there's going to be 1 quote. Because there's 1 quote, there's going to be 1 trade, and then you see the effect on now the central bank has only 4 units that need to remain to be purchased. And so you can see the evolution. So you can see that a trade would affect the trading range that's quoted and the future transaction price that you expect to see in this model. And then below here, you can see that as soon as you have a very high eta, 9 people quoting on average 5 units to be purchased, then you get close to the competitive outcome. Now, the one thing that initially when I saw, I thought was completely wrong and thought we had made a mistake, is that you can see that the trading range actually goes above the reservation value. Remember, the central bank has a reservation value of 1, so the maximum price it's willing to pay, you would think, is 1, And yet what you can see is that the trading range in some instances can go above 1. And so how is that possible? It has to do with the definition of the trading range, with the reservation price. So let me give you the intuition, which I thought is kind of cute. The intuition is very simple to get. Suppose that you want to buy 2 units over 2 rounds from 2 dealers. And suppose that in every round, the 2 dealers quote with probability 1, and they know that. Now, suppose that the reservation value is 1 per unit in the last round. So of course, suppose you enter the last round and you need to buy 2 units from 2 dealers, and you know they're both quoting. So then, of course, every dealer knows that they're going to sell you their bond, and so they're both going to charge you a price of 1. So now you go to a period before. At the period before, you need to buy, you need to buy these 2 units over the next 2 rounds. You go to the dealers. How much are you willing to pay for 1 unit from the dealer? Well, you're willing to pay up to 2 minus epsilon to get 1 bond, because in the next round you will enter needing to buy only 1 unit from 2 dealers with quote with probability 1. That means the dealers in the second round are facing Bertrand competition and will charge you 0. So that means you're going to get the second unit in the next round at the price of 0, and therefore you're willing to pay more today than your last period reservation value, if you understand the intuition. So you can, even though of course in the last round we agree that the maximum price you'd be willing to pay is 1, you have an incentive to pay more than 1 in earlier round to make sure you get the minimum price in the last round. That's sort of the very simple intuition of this model. And so this is of course an extreme case, but it translates into the dynamics we saw on the previous page, where effectively there is a strong incentive to pay a larger amount earlier on to essentially reduce the market power you leave with the dealers in the last rounds. Okay, that was a quick intuition. Okay, so now in the 2 minutes, I want to say, so this model is able to generate this pattern we see, and has many implications that I think are very natural, which are, we would expect that the pattern is more pronounced if there's fewer dealers, or if eta is smaller. So if there's less dealers quoting, we would expect that the pattern is more pronounced if the central bank needs to buy more units. And so we can try to test that by essentially splitting our different windows according to these different this intuition. So first I'm going to show you evidence to try to relate the pattern to the actual purchases. So we run basically I'm going to show you quickly 3 tests in 3 minutes. So one is, we first have a dummy here for whether the bond is actually purchased on that day. So we say, if the pattern is due to the purchases, then and not to say spillover due to general risk aversion, like in the warehousing story, then we should see a specific impact on the price of the security that's actually being purchased in that period. And so what we do is we have this dummy for whether or not the on day T, that actual bond is purchased within window J. And what we see is that this dummy is highly significant, especially in the last couple of days before the month end, which is particularly interesting because actually the target that the ECB is trying to match is T-2, because it takes 2 days to settle. So they actually want to fill their budget, their target by T-2, which is exactly when this dummy for purchases by the central bank of a particular issue is the most significant. Then we have this, we want to see whether this notion of how competitive is, or how many dealers are quoting has an impact on that pattern. So we split the month windows into windows in which the ECB is trading with more dealers, and windows where the ECB is trading with fewer dealers. So the idea being, if there's fewer dealers that are quoting, they will do most of their trades with the same dealers. There might be more market power on the side of the dealers than in month where they're going to many different dealers. And what we find is that this indicator for few dealers is highly significant. We see very significant. So in month where they're repeatedly going to the same dealers and there's few dealers quoting and trading with the central bank, we see a much stronger pattern than in the other months. Then the model says the more you want to buy from the same group of dealers, the more the pattern the stronger should be the pattern. And I told you that the central bank had this idea to trade more in the more liquid months and less in the less liquid months. And so what's interesting, what we find is that the pattern is much stronger and significantly so in the month where they trade more versus the months where they trade less. And that's interesting because in the month where they trade more is when market liquidity is better by standard measures. And yet there, our measured price impact is larger. So it sort of suggests that, what matters is that they want to buy more, and that has an impact on that leads to a higher price impact pattern, even though market liquidity is better in these months. And then the last, well, that's it. Okay, I'm done. So last thing we do is we also look at, well, what's the cost in some sense of this? And we have a very simple measure, which we're getting some pushback on, but of course we're just looking at, simple implementation shortfall, right? How much, suppose that they had done all their purchases at a T-9 at the price observed then versus how much they actually paid for those purchases, it turns out that the implementation shortfall is 233 million. Of course, I'm not saying that they could have done all their trade at T-9 without having any price impact given the size of the trade. It's just an interesting measure, interesting quantity to compute to get a sense of the magnitude at hand here. So the total implementation shortfall for trading German Bund, roughly 13 billion per month during the APP period is about 233 million, which translates, if you want to have a sense, into about 20 basis points. So it's a 20 basis points slippage in terms of market value. So it's not enormous if you compare it to the total dollar amount purchased, but it's something that maybe you could have avoided, paying the full scale of. All right, so I'm out of time. I'm gonna stop here. I have a few more slides, but we can have a discussion instead about what this means for how you might want to design this program. So we already discussed those, and Pete pointed out some of the things you might want to do. I think one of the things we didn't mention yet is some proposal that also Daryl made about maybe allowing, having some electronic platforms for central banks to buy assets that would be open to more than just dealers. For example, buy-side firms. You could imagine that insurance companies or BlackRocks or other type of institutional buy-side investors could also be sellers of bonds to central banks when they want to buy, and that might be something that would be interesting to consider. Of course, it comes with many other issues, but it might be an interesting thing to think about. Sorry for going over time.
Thanks. Yeah, thanks so much, Pierre. This was great. I think we should continue the discussion for a little longer, if that's all right with you. We have a very long comment type question from Carlos. Carlos, do you want to ask it in person? Do you want me to read it out? If you want to ask it in person, you could just unmute yourself.
I'm happy to ask it. So the ticket figure of 233 million euros sounds. Can you hear me?
I don't hear you very well. I'm sorry.
Find a place there.
Maybe if you just speak a bit louder, then we'll be able to hear you.
Is this better? Is this better?
Yeah.
Can you hear me? Yeah. My apologies. Yeah, the ticket figure of 233 million euros, I think, is a big eye catcher for sure. My understanding is some of the folks on the U.S. side, and indeed, got a private sector actor to execute some of these, we'll call it unorthodox efforts. My question to you is do you think that how much of these 200, let's assume blue sky, that the price tag was 233 million, that the execution here, how much do you think could be clawed back if it was just a market player doing this? I mean, do you think that there's there's so much efficiency there to be gained, and have you gotten a chance to look at how it was done in the U.S.? Or my understanding was I think particularly on the mortgage market, is like, they have a mandate, and I think it was brought in BlackRock, and they said, BlackRock, do this, so this is what we're looking for, and it was executed as such. And any comment on how much do you think that adding more private sector in the policy implementation phase could look like? in some sense here, because the ticket figure is a little scary. My apologies.
I mean, I think first of all, I think we have to put this into perspective. 233 million sounds like a lot, but oops, sorry, you still see my slides, right? Sorry, I'm in the wrong. Yeah, 233 million sounds like a lot, but it's only 20 basis points of the total amount purchased, right? So if you think about 20 basis points, it's in the eye of the beholder whether this is large or not large. I was trying to find the data on how much they actually purchase. I think I have the number somewhere, but it's about roughly 13 to 17 billion dollars per month. So you multiply that. I think it was they bought about 127 billion worth of German bunds for that period of time. So if you put 233 million in relation to 127 billion, of course it's better to save 233 million and to hand them over to dealers, but it's not enormous. And then I think indeed, if you buy what we tried to say, that part of the mechanism is not great given the non-competitive market structure, or non-competitive, by the way, I don't mean that they're explicitly colluding. I mean that there might be also forces such as regulation around end of quarters. Some dealers have some constraint on their balance sheet. They just cannot take on additional repos, and so they just refrain from quoting, or they quote too wide bid-ask spread. That means that the other guy who actually have the balance sheet capacity, they will just quote more aggressively, and they'll get better, and they'll get a better outcome. So I think if you think that the mechanism that we point out is partially responsible, then yeah, there's simple ways to probably reduce that cost to the system by quite some fraction. So Pete was saying just trade over a longer period of time, treat repeatedly. Obviously, go to more than just a few dealers repeatedly. Open up competition to a buy-side firm who may not have the same constraints, and then I think be in the market more often with electronic trading platforms on which you can always trade, and be a little less predictable. I think to me those are very simple things that the central bank can do. And of course, when you talk to them, they say, "Well, but you mentioned the operational cost of us setting up a platform," and so it's true that these are one-shot costs that you have to bear. I mean, you have to probably hire some guys who are good at programming. There's some fixed costs to pay ex ante, but at the same time, I think those might be things worthwhile incurring, because we think that they might have to repeatedly be active in markets and buying and selling. Daryl Duffy and others have this discussion of what happened during the COVID crisis in the treasury markets, pointing out that there have been repeated instances in history where central banks have had to act as buyers of last resort. So if we think those things are important events and very costly for taxpayers, then probably having a structure that's in place would be a good thing.
And pardon again my ignorance in my shortcomings. I think the colleagues actually mentioned exactly how the Fed did it on their end, but just not sure if it's helpful to you. You mentioned you're getting pushback from regulators. I think the number that you mentioned on $100-something billion worth of Bundesbank number should be very close to the time when you announced to regulators that taxpayers paid something like 240 million euro. If those two numbers were closer together, it would probably be interesting, so that everything is relative, as they say, right?
Yeah, no, indeed. I think part of the reason why we get pushback from DC is that they're worried about the fact that people will like you jump on that 233 million number and think, oh, we just lost 233 million. It's not what we're saying. It's not, first of all, it's not necessarily incompetence on their part that is responsible for this 233 billion. It's probably more linked to the market structure. And then this 233 million is not a loss. It's a theoretical computation, assuming that you could have done all your purchases at one particular day, one particular price on average. And of course, it's not reasonable to think that they could have purchased 127 billion on one day. I mean, it's not quite that, but that they could have not done their 13 billion per month on one day. So you have to put this into perspective. We just think it's an interesting number to compute, because it allows us to put some figure, and implementation shortfall is something we know how to compute. We understand what it means. It's just, I think it's important to keep that in mind, what it means. And you can see here on this figure, you can see that the implementation shortfall, by the way, is random. It's not like it was constant, right? There are periods of time where actually the implementation shortfall was negative. So actually they did better. So it's not like it was always a loss. But you can see these bars are the implementation shortfall in any given month. And you can see that it's moving around. And yes, on average, it's positive, and it's statistically significantly positive on average. But there are instances where actually they didn't lose by buying over time. These were instances where the price actually was going down instead of going up during the month. So there is some randomness in that implementation shortfall.
Thank you for giving me the honor of representing the average taxpayer. It's an honor for sure. Thank you very much. But in my humble opinion, if you say that something costs 200 and something million, it's always good to say out of an execution of 100 and something billion. You just put a bar graph that shows the cost versus the volume would very easily show that everything is relative.
I agree. I completely agree with you.
Presented here, it's very anyways, my apologies.
No. I agree. By the way, I count myself as an average taxpayer too.
Well, a million here or there adds up to real money at some point, really, right?
You're absolutely right, and I think this 0.2% here is kind of trying to put it into perspective. But indeed, we could also add. I haven't put on the slide the 123 billion. But I think you're absolutely right. It's important to keep that perspective in mind. Yeah.
So just very briefly, Michael Fleming just made a comment here saying that in the US, the Fed buys treasuries and an agency mortgage-backed securities via proprietary trading system where they solicit quotes from all dealers simultaneously, which is a different market structure, I think, that you could pick for this. Now, last thing, Pete has another comment. Maybe I'm just gonna let Pete say his last comment, and we don't want to keep you forever because we're now at 12:15 or beyond 12:15, which is the official end time.
I'm happy to get comments. This is very early research, so I'm happy to get any comment to improve this. So
I just wanted to say that it's very difficult to calculate what implementation shortfall means when you're trading every day, and especially when you're trading in the same direction.
Absolutely. I mean, I think here just the interpret. You see what it means. You see what it's how it's calculated. Exactly how it's calculated. You can see it. It's a way to get some, I think, interesting, useful number, but I agree with you. It has its limitation, obviously. Regarding Michael Fleming's point, I think it's a great point. I just mentioned in the introduction these really nice papers by An and Song, and I recommend them. About even though they use different mechanisms, it seems like every time you have even a sophisticated mechanism, it's hard not to provide opportunities for dealers to be able to extract some rent. So I think the two papers I mentioned, they look at actually the QE purchases of treasuries and of mortgage-backed securities. And for example, for mortgage-backed securities, they show, and they have a little interesting model also of failure of Bertrand competition, where they argue it has to do with quantity constraints. And they show that essentially because the dealers have to buy ex ante mortgages to resell them to the central bank. That that essentially the larger dealers are able to resell at the Fed at non-competitive prices. So it's I think a very interesting paper they have. So so I think it's still an interesting avenue to think about how we should design these programs, and buying multi-units and asking for auctions on multiple units. I think is probably an interesting avenue, but it's still not obvious how to optimally design that. So I think it's an interesting thing to think about.
Is there any consideration? I mean, so what you described was that you could have a different market structure where you have, you have a single platform where you have other people quote. Could you imagine that there could be another mechanism that you could have, which is, people have to pool liquidity, and then there is some form of predetermined rule that determines what the price will be given the given liquidity and given the liquidity demand?
Good question. I'm not sure what you mean. Actually, I'm not sure what you mean by that. But
this comes from the blockchain world, and the blockchain world actually have a way how to, we're trying to implement this with fixed rules where people simply just have to submit their liquidity, and then there's a rule against which everybody else has to optimize. It's just a different way how you can arrange the liquidity so that you have no competition, as in you don't compete for a spot in the limit order book like you do in equity markets, and yet you have pretty deep markets that couldn't be created that way. I was just wondering if that's maybe a solution that could also be implemented, but it's a little bit blue sky thinking maybe.
Sounds interesting. Sounds interesting.
In any case, we're already at 12:20 almost. So if are there any remaining questions for Pierre? Because if not, then I want to thank you again for your contribution and for your presentation today. It was very interesting. I think we all learned a lot about a new market that is probably not so much now our radar, and this very equity focused group. And with that, we have one more talk in 2 weeks from Jean-Edouard Colliard. And you're going to get an announcement as usual the weekend before. And so thank you, everybody. And thanks again, Collin, for your presentation.
Thanks a lot for your comments and the invitation. Thank you. Bye, guys.
Great presentation. Thank you.
Thank you.
I think I can close the reading now.
Yep, you can close everything now, Xiaoxing.
Yeah.
Thank you.
Thank you.